Very good morning, one and all. My name is M. Srinivas from Department of Management Science. Now, I am going to discuss about the subject called as accounting for managers. First of all, we will see what is accounting. Accounting is a systematic, comprehensive recording of all the transactions, what is happening in the organization. You know, in the daily aspects of the organization, there are a number of transactions maybe happen. Then we have to read it and we have to store it somewhere, because we don't know what are the things happening in the organization, especially in terms of finance. So we have to store in systematic manner. That's why we need one system, that system called as accounting system. Here there are key elements of accounting. There are recording transactions, financial reporting, and analysis and interpretation, and finally auditing. We need to do all the elements in the accounting process. Now we'll see what are the principles of accounting. You know, while preparing accounts, we need to follow the basic principles called as business entity principle. You know, whatever transaction happening in the organization, that has to be clearly treated as separate destiny of accounts. You know, second principle is going concern principle. Business is a continuous process. One thing happens and next one, another thing is going to come into the organization. And the principles of the going concern is to be very important, because business is going to happen every day from up and downs to maybe it may go to high or it may go to down, but it may continue for the future also. So that's why the going concern principle gives us information as the costs what are happening in the organization. And next one is monetary unit principle. You know, every transaction happening in the organization, and we are treating that transaction in terms of money. Without money, we cannot run the organization. So every principle, every activity of the accounting will include in the monetary form. And next one is cost principle. Yes, cost is a very important thing in the organization. You know, cost, we need to purchase materials and we need to purchase various things which are useful for the organization. For every transaction we need to pay price. We have to purchase from somewhere, and whatever purchased, we have to utilize that all purchases in the organization. So for every transaction there is a cost. That cost has to be treated perfectly in the organization. That will be included in the cost principle. And next one is matching principle. Yes, what are the things happening in the organization that should be matched? If it is 10 rupees and whatever transactions happens with the 10 rupees, that has to be exactly matched. So that is called as matching principle. Next one, revenue recognition principle. Yes, cost is happening, and what are the things happening in the matching principle that should be matched only for revenue recognition, only for revenue generation in the organization. Without revenue we cannot run the organization, because revenue is the only principle to continue the organization. Without having revenue, how can we survive? So that is the thing, and that is also will be included in the principles of accounting. Next one is consistency principle. Yes, you know, consistency means, for example, if we maintain accounts for 3 months, that has to be continued. If we are maintaining accounts for 6 months, that has to be continued. Whatever time period we have selected, that has to maintain for a specific period of time. That has included in the consistency principle. Next one is materiality principle. The principle suggests that only information that could influence the decision of financial statement users needs to be disclosed. You know, financial statements has to be clearly disclosed while preparing the accounts. You know, we need some clear-cut information. What are the materials we need to use? And next one, full disclosure. Yes, whatever transactions are happening in the organization, that has to be disclosed. Means that we need to maintain some proof. You know, that proof is the only source. What are the prices we have maintaining in the organization, what are the costs are happening, and what are the expenses are happening. Everything has to be disclosed in the preparation of accounts. And the next one is, the important topic is classification of accounts. Actually, we have classified the accounts into three categories. The first one is personal account, real account, and nominal account. Here we have basic rules for personal account, real account, and nominal account. You can see personal account name itself gives you information. Personal account is containing with the person names or organization names. And the rule is, personal account rule is debit the receiver and credit the giver. And coming to real account, and real account is belongs to all the assets of the organization. And here there is a basic rule, debit what comes in and credit what goes out. And third one is nominal account. This is belongs to all expenses and losses, all incomes and gains of the organization. All will be included in the nominal account. And we can see the rule, debit all expenses and losses, credit all incomes and gains. So I can say that this classification of accounts is the heart of the account. Whatever transactions we are doing in the organization, that should be perfectly maintained based on all these three types of accounts. Next, who are the users of accounting? Yes, we can see the management. Generally they will observe what are the things happening in the organization. Management definitely will check what is happening about financial transactions in the organization. They are the users. And next one, owners or shareholders. Yes, shareholders, they are the key persons because they have to invest in our company. If the balance sheet, if the profit, if the revenue is high to the organization, definitely they will attract and they will invest in our company. So if they want to invest, definitely they will search all the accounting information is happening in the organization. Next one, creditors. Yes, if our financial capability is good, definitely we'll get amount from our creditors. Next one, employees. Yes, employees also will check what are the things happening in the organization about the financial transformation, because if the company is going financially sound, then only they will be happy. If company is getting losses, they cannot survive. So if company is getting good profits, definitely they will give their best. Next one is government and regulatory authorities. Yes, very good. The government is also observing what is the things happening in our company, because they need to give some permissions and they have to maintain some rules and regulations in the organization. And the government will give some subsidies also if the accounting or if the financial position is good or bad, because government is the key factor where our company wants to go smoothly in the organization. So government is a key factor, government and regulatory authorities. Next one is customers. Yes, customer. And finally, the customer have to accept our company, because the revenue will be generated from the customers only. If the customer believes, definitely they will stand us as a leader in the market. If they won't believe, the customers may damage our business because they do not believe. So customer finally have to accept our company. If they want to accept, our position has to be good. The next one, competitors. Yes, obviously if there is a competition, the quality of the business is there. If there is no competition, quality may be there, but we cannot maintain such a good quality. So competitor also will observe what are the things happening in the organization. Next one, books of original entry. Yes, there are some basic books we need to maintain in preparation of accounts. The first one is cash book. In the cash book, we need to record all the cash transactions. And next one is sales day book. Yes, there are number of sales that maybe happen in the organization, and what are the how much quantity sales happen today, tomorrow, day after tomorrow, and previous day. Everything will be recorded in the sales. Next one is purchases book. Yes, what are the purchases, what are the goods and services we are purchasing from various sources, we need to record in the purchase books. Next one, sales returns. If there is any damages in the sales, definitely will get back, and that will be recorded in the sales. And next one, purchase returns. If we purchase something from the client, if there are any damages, we need to return back to the person, so that will be recorded in the purchase returns book. And bills payable and bills receivable, so obviously these two books also will have to be maintained in the organization. Next one, petty cash book. Different small expenses, petty expenses and small and routine expenses has to record in the petty cash book. Next one, journal. Yes, what is journal? Up to now we discussed what are the transactions, what are the things happening in the organization. Then how can we record? We record systematically in the form of journal. Journal gives you a financial freedom to understand, and day to day we can return what are the things happening in the business. And next one, from journal we need to go for ledger. If journal completes only, we can enter into the ledger, and ledger gives you information about the individual accounting information. If for example Ramu is the person who is coming to our organization and is a part of the organization, if you want to know about Raju's transactions, definitely we need to maintain one ledger on Raju. Then if Raju ledger opens, definitely what are the transactions happening with the company, with Raju, we can see day to day. So ledger is a key point in the preparation of accounts. Next one, trial balance. Yes, it's true. It is very important. What are the things happen in the trial balance that has, ledger, that has to be systematically recorded in the trial balance. If you say what is the meaning of trial balance? Trial balance is a fundamental accounting report that lists the balances of all ledger balances. Yes, all ledger balances we prepared. There are a number of ledgers accounts, but all the ledgers should be recorded in a systematic way. It is called as trial balance, and trial balance has to be matched for the financial year ending or quarter year ending or half yearly ending. The balances should be matched. What is the debit balance, what is the credit balance? The balances should be matched. This is the example. If you observe, these are all the ledger accounts and balances we drawn here, and finally these two balances have been matched. The trial balance gives you information for the further preparation of financial statements. And next one is the trading account. Yes, what is trading account? Trading account generally we utilized to find out gross profit, and trading account will be prepared for finding out gross profit, as well as in the trading account all the factory expenses will be included. And from the trading account, if you get gross profit, that has to be transferred to profit and loss account. And profit and loss account, the major objective is to find out net profit. So whatever transactions happening, finally we need to create whether we are getting profit or loss. If it is net profit, that has to be transferred to balance sheet, and if it is net loss, it has to be deducted from the capital balance in the balance sheet. We'll see what is happening. This is a pro forma of trading account, and trading account starts with opening stock and ends with the closing stock. And if you see here, gross profit, the objective of trading account is to find out gross profit. And next one, the gross profit will be transferred to profit and loss account. Here we can see the gross profit from trading account to P&L account, it has been transferred. And if you observe the pro forma of profit and loss account, all the expenses and losses will be recorded debit side of the profit and loss account. And if you get any incomes and if you get any sources of revenue, we can record the credit side of the profit and loss account. So after recording all the transactions, we can get the net loss. This is the objective why we are going to prepare profit and loss account. If we get net loss, that has to be deducted from the balance sheet capital balance, and if it is net profit, we need to add amount to the capital in the balance sheet. Balance sheet, yes, you can see balance sheet is a financial statement where we can see both liabilities and assets. All the transactions of the assets, all the transactions of the liabilities, we can simply record in the balance sheet. This is the pro forma of the balance sheet. You know, here we can divide the balance sheet into two categories, liability side and asset side. And as we have discussed, if it is net profit, we need to add the net profit to the capital balance. If it is net loss, we need to deduct the net loss from the capital amount, and obviously the drawings amount will be there or may not be there, but if it is drawings amount, we need to deduct from the balance. That is the final balance for the capital amount in the liability side of the balance sheet. And coming to current liabilities, if you see the current liabilities, long term loans, debentures, they are the current liabilities, and so non-current liabilities. And current liabilities, if you observe, trade creditors, bills payable, outstanding expenses, advances and short term loans, they all comes under current liabilities, and they are the non-current liabilities. You know, debentures are the bonds, and debentures are the long term debt instruments for the company. Yes, maybe after 1 year, after 2 years, we need to pay back, but till then we have to maintain in the balance sheet as liability. We have to pay interest to the liability, and for the bonds and debentures, some certain amount of interest we need to pay to the debenture holders or bonds holders. That is the basic thing, and we have to maintain that. Why we have to maintain debentures and why we have to maintain bonds? Because there are some certain sources of getting amount from various sources to the organization. How can we get? We can get amount from family, we can get amount from friends, and we can take loans from banks, we can take loans from financial institutions, and after that we can issue equity shares, we can issue preference shares, and we can issue bonds and debentures. They are all the sources of finance. So if we have, we can write down. Otherwise, what are the things happening, what are the things available, we can include it in the non-current liabilities. And come to fixed assets, asset side. There are current assets and there are fixed assets. You know, non-current assets or fixed assets. Building, land, plant and machinery, furniture, goodwill, these are all the fixed assets. Fixed assets means which we cannot convertible into cash easily. It takes some time. It may be 1 month, 2 months or 3 months, whatever it is, but we cannot easily convertible these fixed assets into cash. That's why we are calling them non-current assets. And we have depreciation on buildings, and we may have depreciation on land, we may have depreciation plant and machinery. If we are having the depreciation, we need to deduct from this fixed assets value. And current assets, inventory is all there, bills payable, bills receivable is there, and sundry debtors are there, prepaid expenses are there, accrued incomes are there, cash in hand, cash at bank. This all comes under current assets. So balance sheet balances also should be matched. You know, if you don't get matched the balance sheet amounts, something happening in the all the ways of the calculation of the financial statements. We may have some mistake in the trading account, or we may done some mistake in the profit and loss account. So if you done any mistake in these two accounts, definitely this balance sheet amount will not be matched. And we can see what are the limitations of financial statements. Yes, there are some limitations. The first one is historical information. Yes, we are going to prepare accounts based on the happening things. We are not calculating accounts for the future activity, what are the things happening in the future. We cannot prepare like that, because accounts will be giving information actually happened things in the organization, that is historical information. Next one is estimates and assumptions. As we can estimate and we can assume based on the accounting information. There is a limitation, but we cannot predict 100% accurately. But whatever the things happened in the past, by taking all that information, we can predict, we can reduce cost, or we can increase profit based on the estimation of the past things. Next one is qualitative factors ignored. Yes, accounting may give you information about the actual things happen. We cannot get the quantifiable data or overlooking qualitative factors, because some of the things may not be recorded sometimes, because they are pretty expenses. So that may be difference is there to find out the quality factors ignored. Does not reflect the market value. Yes, as we have discussed, the accounting information may not affect our organization hugely, because everyone wants to maintain their goodwill in the organization. Everyone wants to maintain or increase their profits in the organization. So if we are having, definitely public will accept us. If we are having good profits, customers may come to us. So that's why this will not be reflect the market value. And next one, the next topic is depreciation. Yes, what is depreciation? Depreciation is the method where we can calculate on fixed assets, and it is a residual value, and depreciation should create or should calculate on land, buildings, machinery, plants, because we don't know what happens tomorrow. And while machine is running, while plant is running, there is no problem till the final stage of the product. The machine will gives you 100% effort to create the qualitative product. If in the peak time, if machinery stops, if machinery definitely some may get some problems, may get some repairs, at that moment whatever depreciation amount we calculated and maintaining, that will be helpful to maintain or to purchase a new machinery instead of the old one. So the organization has to create depreciation on every machinery, land and building, and patents, as well as the plant also. And what are the depreciation methods? Basically, as per our convenience, we are calculating only two major depreciation methods. The first one is straight line depreciation, and second one is declining balance method. Coming to straight line method, for example, I'll give you one example about straight line depreciation method. A machinery purchased for 1 lakh rupees, and for every machinery there is a lifespan. For example, for that machinery we have given 10 years of lifespan, and the machinery cost is 1 lakh, and every year 10% of depreciation we need to calculate on that machinery based on the straight line depreciation method. So in the straight line method, for 10 years, for every 10 years, for every 1 year, 10% of depreciation value, that is 10,000 continuously will continue for 10 years, that is called as 1 lakh will be finished. But this is a very simple method to calculate depreciation. And second one is declining balance method, or reducing balance depreciation method. Here we can calculate depreciation in different way. For example, in the straight line method, every year 10,000, 10,000, 10,000 up to 10 years we calculate depreciation value. But in the declining method, for same example I am applying here, the machinery cost is 1 lakh and the depreciation cost is 10%, and the life of the machinery is 10 years. First year 10,000. From the 1 lakh, if we deduct 10,000 rupees, the balance is 90,000. and from that 90,000, 10% of depreciation method, 10% of depreciation value we need to deduct. That amount will be as 9,000. From 90,000, 9,000 if you deduct, 81,000 is there. From 81,000, 10% depreciation cost is 8,100. Likewise, we need to calculate depreciation in the declining balance method. So this is very important method. These two are very important methods in the depreciation, because organization is going to concentrate much on depreciation, because every organization directly or indirectly depending on the machinery. Through that machinery only we are calculating, or sorry, we are producing qualitative products in the market, in the organization. Through machinery only we can maintain our organization in a smooth way. If the machinery is getting any repairs, instantly we cannot get loans from the banks, no one can help us. So this depreciation amount will help us to replace that machinery. So organization or the management is giving much priority for the depreciation methods. Coming to next one, the ratio analysis. What is ratio analysis? It is a financial analysis technique that involves evaluating relationship between financial statements. There are number of financial statements like profit and loss account, trading account, balance sheet, funds flow, cash flow, and ratio analysis. So this is one of the financial statement technique. But here this ratio analysis will gives you the information about the assessment of the assessment of the financial health and performance and efficiency of the business. Yes, this is also very important financial statement technique. Here we can know ratio analysis based on the different types. Here we see there are number of ratios: liquidity ratio, profitability ratio, and activity ratio, and market ratio. The first one is liquidity ratio. So in the liquidity ratio, just if you observe, these ratios assess a company's ability to meet its short-term obligations. Short-term obligations, like example is I have given current ratio and quick ratio. In the current ratio, what is the position of current assets, and if the current assets are good for the organization, definitely the financial sound of the organization also will be good. So these liquidity ratios will gives you information about all the current assets position happening or maintaining by the organization. If the current assets ratio is not matched as per the standard ratio, we need to concentrate more on that, because this current ratio is very important thing. This current ratio may generate high profits to the organization. Same, if it is not matching the standard ratio, the organization may get some losses. So definitely we need to concentrate much on liquidity ratio. And coming to second one, profitability ratio. As the word contains the meaning, profitability ratios. These ratios measures a company ability to generate profits in relation with revenue and assets and equity. Yes, for example, here we can see ROE, return on equity, and return on assets. Yes, return on equity. Our company may invest somewhere. If you are having some additional amount, our company may invest somewhere. That investment has to generate more profits to the organization. That is called as return on equity. You know, our investment sometimes may not generate profits. Then the company has to take some decision. Our investment has to change from X factor to Y factor, because X company is not giving profits to our investments. Then immediately we need to change our investment to another company where we can get profits. And return on assets. Yes, we invested our amount somewhere on land, and we purchase some land, we purchase some machinery, we purchase some trucks, everything. Whatever amount we invested on assets, that has to be generate additional revenue to the organization. Otherwise we need to focus on this. And next one is activity or efficiency ratios. Yes, exactly. The word contains the real meaning. We have to maintain a perfect relation with the inventories. Inventory means goods and services. Inventory is the basic thing to create a product. Without having inventory, we cannot generate any type of product in the organization. So we need to get a qualitative material or qualitative inventory from the parties. Then we can produce a quality output. So that is the basic thing. And this ratio will gives you information as what is the quantity of raw material we got and what is the qualitative output we got. And if it is good, no problem, we can maintain happily the same ratio in the organization. If there is any deficiency in the output of the organization, we have to focus on again the inventory. We have to maintain inventory perfectly. Next one is solvency or leverage ratios. You know, sometimes we may get debt somewhere and we have to pay interest to them, and we have to get we may give amount to the others also, we have to get interest from them, and this debt equity ratio may be maintained perfectly in the organization. That is the thing. The ratios because a company's long-term financial stability and its mid to long-term operations. The example is including debt equity ratio and interest coverage ratio. How much we are paying as interest and how much we are getting as interest. If we are having investments, definitely we'll get a return in the form of interest or something. That has to be clearly known by the people who are maintaining all these accounts. And next one is market ratio. Earning per share. For example, our company invested in some company. You know, directly we cannot invest. We can invest on shares of the company. That shares has to generate some revenue to the organization. And based on some situations, the company may generate high profits. At the same time, in the crisis, the same company may generate some losses also. But this ratio will gives you information, the balance sheet of the investment. So we need to wait until the profits, until we get profits. Instantly we cannot get profits. It takes some time. It may be 6 months, it may be 1 year, it may be 1.5 years. We need to wait. Then instantly we cannot get, but in the future we get profits. You know, I'll give you an example. Recently, due to Corona, all the companies fell down, but the investors felt very bad about their investments. But 90% of people, they didn't get back their investment. They waited in the market. So later, from 2019 to 2020 ending, stock markets are stabilized. Later 2020, after we entered into 2021, all the highest points of the stock markets break down, and everyone who waited in the stock market, they got good profits. So waiting is a very easiest method to get high profits in the stock markets. So earning per share gives you information where we are investing and how much percentage of amount we are getting back from the company. So this is about the market ratio. Thank you very much.